Good evening, everyone, and welcome to another exciting edition of Bond Squad After Hours. This is your host again, Tom Byrne. Let's get our disclaimers out of the way. Investment advisory is offered through Private Advisor Group. PAG is a separate entity from Wealth Strategies and Management and Bond Squad. Of course, this broadcast, as always, is brought to you by Wealth Strategies and Management and Bond Squad, 907 Main Street, Stroudsburg, Pennsylvania. Well, it's been an interesting week so far in the bond market and the financial markets in general. We saw some wild swings during the past several trading sessions. Late last week, we saw, let me turn that down here. Sorry about that. John Fogarty just insists on getting on the act, and we'll have him on sometime, when it's more appropriate. But we saw the bond market swing wildly. We saw the equity market swing wildly. Last week, we saw equities plunge on some surprisingly weak economic data. It kind of rattled people. We also saw it rebound this week, and that surprised some people because the economic data really wasn't anything to write home about. In fact, since last Friday, we've had indications that the economy is starting to, I wouldn't say slow down, but settle back in to its 2.5% to 3% growth area. And, Bond Squad has been among the minority of strategy concerns and portfolio managers, in that we did not think that Q2 and Q3 of 14 were real. 4.6 growth in Q2, 5% in Q3 was kind of overdone, and they were high for various technical and seasonal reasons. So we're pretty much back to where we were. Now, this shouldn't come as a surprise because we saw in the regional Fed data that the pace of hiring slowed in most regions. And we had the work week shrink in every region. So what does that tell you? It indicates that hiring remains good but not great. And since the work week is shrinking, there's a tendency to hire part-time workers rather than full-time. And we even saw something in the Chicago Purchasing Managers Report last week, which indicated that business leaders, business executives are intimating that temporary, contractual / part-time workers is going to be a permanent class of workers. It's no longer a stepping stone. A stepping stone into a full-time position. The economy is structured much more differently, and this might be what we get, as we've said it, ad nauseum before. So coming up now on Friday, we have non-farm payrolls and the unemployment rate, and the street's calling for 230,000 new jobs, 225,000 in the private sector. Today, we had the ADP employment report, which indicated 213,000 new jobs. Right away, everybody defended, saying, hey, it's the fifth print in a row over 200,000. It's the longest stretch for job growth, over 200,000 per month. And it's a sign that the economy is in good shape. We don't disagree that it's in good shape. 200,000 jobs for 5 months in a row is nothing to sneeze at. But let's consider the amount of stimulus we have. We have still rates near zero. The Fed still has a large balance sheet. So what this tells us is that the structure of the economy has changed. All right. So we don't have the need for as many full-time people. And one of our contacts on LinkedIn, he follows us on for our blog postings, Paul Wingard, who's an associate professor at Bethel College. He has a great article up there that he wrote on the output gap and how the output gap is wider than ever. And not only does output change, potential output changes. So now we have an output gap, and I don't need to steal Paul's thunder, but he made an excellent point today. We have potential output that can more than satisfy demand. All right, so we don't need to use all our potential output. And we mentioned this as far back as our days at Citi, that maybe this surplus capacity in the capacity utilization data was really superfluous, not surplus. In other words, it's there, but it's not really needed. And that's scary when you think about it, because that means that a lot of these workers who have left the labor force might not be needed in the labor force again, or at least not at given wage levels. So this means that they can be replaced or supplanted by equipment. Jobs can also go overseas. So when we look at employment, we think it's steady as she goes. The unemployment rate, depending on the labor force participation rate, will probably hang somewhere in the mid fives. It was 5.6 last month. It probably stays 5.6, 5.5, maybe even goes to 5.4. But remember, we have to understand what drives the unemployment rate. And it's really how you answer the so-called household survey. We've written this many times. There was an article that we saw today, which stressed the peculiarities, if I can speak properly today, of the household survey, the unemployment rate. So basically, if you're unemployed and you answer that you're not seeking a job, then you're not considered unemployed. If you are employed rather, and you're working, a part-time job, a temporary job, something that leaves you underemployed, and this is where the underemployment rate comes in, you're considered employed, and that number goes down. So the size of the labor force really drives that. So if all the working age people who could potentially work were seeking jobs, our unemployment rate would probably still be north of 11%. And we should rephrase that. Not all the people, but just the same percentage of people as we had in the past few economic expansions. If they were seeking employment and were unemployed, we'd probably have an unemployment rate still north of 11%. So that tells you how much slack we have in this economy, or at least slack in the labor force. The question is, how do you absorb all that slack? It's really not easy. If unless you become a Luddite and start smashing equipment or become protectionist and don't let jobs leave the country, which has another set of consequences as far as price, competition, quality, then you really can't use it. So, the easy answer, at least in theory, is to encourage business creation. And remember, new business creation is at a post-war low. Gee, that could help, but we don't have any fiscal policies to drive that, and that's a problem. We're relying on central banks to drive everything, and that's what's really driven the market. I mean, we've seen this. When the Fed stopped tapering or hinted at stop tapering, we saw weakness in the markets. Right when we had the ECB, mention QE, right? We saw European equities strengthen and the market sentiment could become bullish on European equities. When it looked like the ECB was reaching a deal with Greece, we saw the dollar weaken, the euro strengthen. We saw U.S. Treasury yields rise. We saw the equity market strengthen. Right, and then late this afternoon, we hear a statement from the ECB, which says, "Don't automatically assume that the Greek negotiations have a positive outcome." Bang! We give up all the gains we had on the day in the stock market, and we saw U.S. Treasuries rally, yields fall, prices rise. All right, central banks are calling the shots here. Yes, there's fundamental strength in the U.S. economy, but a lot of the market strength is due to central banks. And remember, market strength and economic strength do not always go hand in hand. In the past few days, we saw bonds sell off, we saw equities rally. Now, some of that was Greece, which to us here at Bond Squad is stupid. You're talking about an economy about the size of Rhode Island. Yeah, it could have extenuating circumstances. If they leave, maybe Italy leaves, Spain leaves, Portugal leaves. But this is like being upset because the junkyard down your street might move, and it might take the crack house and the toxic waste dump with it. All right, maybe the EMU shouldn't exist as structured. This is not the first currency union. The Scandinavian countries did it from 1865 to 1914. That being Denmark, Sweden, and Norway. That's why they all have a currency called the krona. I mean, at one time Sweden had the Riksdollar, which is the Riks, similar to the German Reich government. So that was that was one of the previous attempts at a currency union, and for various reasons they did not stick with it. But interestingly, all three countries still have the krona, albeit a sovereign krona rather than a joint krona. So if people are actually using Greece, and whatever bailout or negotiation terms come out of that as a reason to push up or down risk assets, boy, that's kind of like reaching out there as far as we're concerned here at Bond Squad. We're not momentum traders. If people want to take up low quality assets for various reasons, we're not day trading. We're not short term trading. We're not going to jump on board with that because fundamentals almost always win out in the end. And the same, if people are bailing out on high quality assets for various reasons, we're not going to play that momentum in short. We might jump in and buy on the weakness of high quality assets, depending on client suitability, but we're not going to join that. We're very fundamentally based. So I was driving home from Philadelphia Tuesday morning after dropping my daughter off at the airport. And at that time, we saw the equity markets, actually still equity futures, rallying. We saw Treasury selling off. And throughout the day, on the way home and throughout the day, the various pundits were out there. They couldn't figure out what was doing it, what was causing this. So everybody once said, all right, it's grease and oil. Oil had something to do with it, but oil was more of a result rather than a cause. And we go back and think that when we look at the data, it's all about currencies. Remember, any type of policy accommodation, especially QE, one of the goals of this accommodation is to weaken one's currency. You make exports cheaper, you boost up some inflation. So the currency factor really drives these markets these days. And it makes sense when you look at long-dated treasuries, as we've pointed out, and the financial media, we kind of, really leaned on a Bloomberg writer last night for getting it wrong again. And Dave Kodak at Cumberland is getting a little frustrated with the media not reporting things correctly as well. But as we pointed out, long-term rates, bond yields, price to inflation, not growth, right? Well, what's inflationary? One inflationary force is devaluing your currency. If the dollar's worth less, then things cost more and you have inflation. So a weakened dollar should lead to higher rates on the long end of the curve anyway. It should also be good for exporters. So it should be good for most major indices, stock indices. There's a lot of multinationals in there, right? And also, from a valuation standpoint, if an entity is worth X, and when measured in dollars, with a weaker dollar, well, it's worth more dollars. If the dollar is weaker, the stock price should go up. There are various reasons why a weaker dollar is good for the stock market. So what we saw yesterday, we saw oil prices also rise. Now, some of that was a short squeeze, some of that they blamed on Greece, but the short squeeze really was a result, not a cause. What started off, we think, was a weaker dollar. The dollar started weakening, but for what reason? Well, let's go back to our economic data. We had weaker than expected ISM and market PMI data. We had factory orders contract yesterday, more than expected in the U.S. We saw wage growth, the pace of wage growth stagnate. We had softer data across the board. Well, if you have softer data, that means that you have less of an inflationary environment. And theoretically, that could put off what? Fed tightening. It was the threat of Fed tightening which helped drive money into the U.S., also helped by low and often negative interest rates pretty far out on the curve in foreign markets. So we believe it was currency that was driving the whole game yesterday. And then it snowballed. Once oil prices started going up for a weaker dollar, remember, dollar's weaker, oil, it takes more of them to buy a barrel of oil, oil prices go up. That started the ball rolling. And it sparked a short squeeze that probably wanted to happen anyway, but that was the catalyst. And it pushed long-term yields higher, bond prices down. So we decided to look at, and we were going to publish in today's Making Sense a bunch of charts, but that would have been too over the top for most readers. But we'll show you one that really we think tells a good story. The solid line is the price of the 10-year Treasury, not the yield, the price, and the broken line there is the DXY dollar index. That's the index for the dollar versus most major currencies. And if you see that they're very correlated, as the dollar strengthened, the price of the 10-year strengthened, which means the yield fell. And we saw that. As the dollar weakened, right, we saw the price drop, which means the yield rises. And we ran charts versus oil versus equity prices, and they all told a similar story. So the currency story is dominating these markets. Well, what's dominating currencies? Central bank policy, and it's a race to the bottom. And this is where there's the potential for a currency war. Let's say U.S. economic data does slow down, and it does put the Fed off its plan to tighten sometime to mid to late this year. So let's say the Fed was going to go in June, and then they say, all right, we'll go in September. Then they say, all right, we're going to go December or early in 16. Well, that weakens the dollar, right? Well, that kind of undermines the ECB and the Bank of Japan's plans, because they're trying to weaken their currency. But if our currency weakens, it forces them to go ahead and take further steps to weaken, right? And it keeps the whole game going. And it's a race to the bottom. This is the danger of a currency war. Can anyone really win it? And this is why we don't really see the big advantage of necessarily moving overseas. The idea that, the ECB and the Bank of Japan are easing, and they're doing quantitative easing, so their asset prices will do better, assumes that nothing happens in the U.S. Well, we've seen the U.S. economy start to come back to earth. We saw exporters, the multinationals, take it on the chin a bit with the stronger dollar. So there's a lot of push for a weaker dollar, and maybe the Fed says at some point, you know what, we can't raise as long as the dollar is this strong. And it starts that race to the bottom. So our view is to invest in quality and invest in the strongest economy in the world, which is still the U.S. So we're not one to chase opportunities. We have our views. We don't trade for momentum purposes. We buy actual bonds. We really don't care where the bonds trade in the interim. We have our maturity schedules, our ladders, our barbells built. For the most part, we'll do some tweaking of it, but there's really no reason to chase. We're not ones to buy other types of fixed income investments with share prices and NAVs. That's not what we're about. That's just an equity investment in a fixed income asset class. It's really not fixed income investing at all. So that's where we're coming from in this whole story. So what we're looking forward to now is for job growth to come back to earth, for wage growth not to take off. We don't see a reason why it should. There's so much excess capacity out there that we can meet almost any conceivable demand without appreciably adding workers, or at least having to pay up to add them. There's alternate means of production. It's a brave new world. Demographics don't bear it out. So we think that long-term rates will stay relatively low. But here's a big caveat, and we mentioned this in last weekend's In the Trenches report. Just because rates remain low does not necessarily mean they have to remain this low. And that means, let's say the ECB is somewhat successful and we do see some inflation overseas, and we start to see long-dated foreign sovereigns, European sovereign yields, start to move higher. Well, that's going to let long-term U.S. Sovereign yields, Treasury yields, move higher. Now, there's probably not enough inflation, and there's probably too much demand to let long-term rates rise very much. But let's put this into perspective. We ended the day with the 10-year Treasury note yielding 1 3/4. All right, if you raise that yield to 2.5, which is still historically low, well, that 75 basis point move is going to be like a 6.5 to 7% downward move in the price. So now, if you have a bond with a maturity, you really care. You hold the maturity, clip your coupon in the meantime, you let the price do what it wants. But if you're out there and you're price conscious and you don't have a maturity in your investment, well, that move is going to be painful. It could be permanent if if there's enough selling that goes on in your investment, if it's some sort of mutual investment, or if you go ahead and hit the sell button because your NAV got clobbered, that's a realized loss. So, while we think long-term rates stay low, they don't necessarily have to be this low. They could go lower. We could see a 1.5 10-year, especially if QE is not successful overseas and our economy kind of settles in. We could also see a 2.5. If our economy does get some more steam and we see some improvement overseas and rates rise over there to attract some of the capital back, it's possible. But we don't see the 10-year moving over 3 in this year, next year, year after. We don't see Fed funds going over 3 in the next tightening cycle. We could see the curve go flat with all yields under 3%. And this brings us to what's irking us in the media. We saw it again in a Bloomberg article that rates could still rise because the Fed could still tighten. Let's be clear yet again. When the Fed tightens, that's anti-inflationary. Anti-inflationary pressures tend to slow the rise of long-term rates, eventually stop them, and often start to push them lower. This is how we get flat and often inverted yield curves. The Fed raising the Fed funds rate does not push long-term rates higher. When long-term rates rise as the Fed is raising the Fed funds rate, it's because they were already rising due to inflationary concerns, and it takes a while for Fed policy to rein in those pressures. We don't have those pressures now. So if the Fed starts tightening, we're more likely to see long-term rates stop rising or rise just a small amount, as they were probably rising already for inflationary inflation expectation reasons, but the curve probably flattens in the not too distant future. And we'll say in 2018, maybe 2019, you eventually get the end of the tightening cycle, and you'll probably have a flat curve, barring any unforeseen events, and there are always unknown unknowns. They come up and bite you. But we could see a yield curve in a few years, 3-4 years, with all rates below 3. Okay, so and this has generated a lot of questions from our subscribers who have been buying these fixed to float notes and preferreds. We've been of the opinion that if you're going to do it, get something with a long fixed lockup period and a coupon spread of 3. Then we went to 350. Now even 400 basis points. What we don't want to float in the next 3 to 5 years, because LIBOR is probably going to be low enough, from what we can see now, where the coupons actually float down from where they are. Okay, so if you have something LIBOR plus 300 and LIBOR, which probably going to peg somewhere at 25 basis points over Fed funds. So let's say you have a 2.5 Fed funds, 2 3/4 LIBOR plus 300, you're at a 5 3/4 coupon, but you're buying a preferred with a coupon that has right now has a 6 to 7% coupon before it floats. Well, it's going to float downward at that point. So what we are looking at are fixed to floats that are locked up for 9 or 10 years. Let's get past this period. Okay, we want to be fixed at 5 3/4, 6 1/4, 6.5, rather than float, because floating might make you float down. And hopefully 9-10 years from now, we're in a somewhat more normal environment and we have a somewhat more normal Fed funds rate and LIBOR rates, and we don't have to float down. Plus, your coupon is starting a little lower. Your coupon's more like 6 rather than 7 from the securities issued in the past few years. You can buy them closer to par. The higher coupon ones, you're paying a premium. Your effective yield is similar anyway. So why take the price volatility at that point? So, that's how we're strategizing this. We're not expecting higher rates. We don't think ECB QE is going to be all that successful. We think the U.S. economy is fundamentally capable of 2.5 to 3.5, probably 2.5 to 3 this year. Unemployment, it's a different ball game. There's no reason to really pay up for most workers at this point. They're all alternatives. That's pretty much what we have for this week. I think we covered everything. The economic data is just softer. It's not terrible. We're growing. Early returns, and we've heard this from several economists, and I'm not an economist, but I do track things and I do listen to the to various economists on the street. Well, it looks like the economy is tracking at a 2.8% growth rate for Q1. Okay, maybe it grows at 3, maybe it grows at 2.5. It's in line to where we have been growing, maybe a little bit better even. It's not what we'd like to see. It's not what we've accustomed to see with normal policy accommodation, never mind extraordinary policy accommodation like we have now. But it is what it is. So our advice is to buy quality, focus on final maturities. If you're buying equities, look for dividends. There's no need to be a hero here. Could there be better entry points than now? Possibly. But then your market timing, you want to have some cash on hand, maybe, or just put it in high dividend and growing dividends. And not, when we say rising dividends or growing dividends, we don't mean small companies that have been raising dividends a lot lately. We're more like big companies that pay reliable dividends and have a history of increasing their dividends. I think, and Bond Squad thinks this is a quality play here, and in the bond market, do not expect, even the corporate bond market for spread blowouts in the investment grade area. There's a shortage of bonds out there. There's so much demand for fixed income, and this might seem odd for financial advisors, especially ones in the business the last decade who've been taught to buy packaged product, buy sleeves of this, buy funds, buy whatever. The demand for actual bonds is increasing, both from the retail side, and retail we mean even institutions that have actuarial needs. So insurance companies, pension funds, we'll throw that into retail for now because they're based on the needs of individual investors and other institutions, central banks. They need treasuries. Various institutions need corporate debt. We saw Apple come to market with a 10-year corporate note that priced deal 251 with a coupon of 2.5. So you might ask, who's crazy enough to lend Apple money for 10 years at 2.5? Well, they issued $1.5 billion dollars worth of bonds. They probably could have issued double that size. The demand was there. So the demand for these bonds are there. So there's no reason for this to blow out. I think people are underestimating the demand in fixed income because they haven't really grasped the change in the demographics and in global demographics and the importance that bonds play when foreign central banks manage their currency. We've said this before. When other countries trade with us, they get paid in dollars. So they need to do something with these dollars. If they convert it back to their home currency, they have to sell the dollar, which weakens it, and buy their currency, which strengthens it and throws off their exports. So they roll it back into U.S. dollars. In fact, they might even take some of their own currency instead of stockpiling in their own securities. They go out and buy U.S. Treasuries with it. So, and in some cases, U.S. corporate debt as well, especially if it's foreign companies, and foreign private entities to the extent that they exist. So we just don't see long-term rates blowing out. Could they rise? Yes, but they're probably not going very high. Again, we're still laddering, we're barbelling, we're appropriate, and we're trying to stick with quality. The biggest names in the best sectors, sniffing around at oil companies, looking for low balance sheet leverage, and looking for companies that don't need to refinance in the near future, so they get some breaks. Expect more consolidation in that industry, and it's steady as she goes. Beware of the tinfoil hat people. We're probably not going into a recession anytime soon. Our yield curve's not pricing that in. Some yield curves are pricing in a slowdown. Ours isn't. Steady as she goes, and that's all we have for this week. If you have any questions, please give us a call at our office during market hours, 570-424-1555. Drop us an email, thomas.byrne@WSWhiskeySam, the word and, M as in Mike.com. And that's all we have for this evening. Have a great night. Bye.